Hi everyone, thanks for taking the time to listen to my presentation today. My name is Ciara Jones and my company is Meituan, ticker MPNGY, and they are a Chinese company with a 270 billion market cap that focuses on food and consumer services delivery. I originally found Meituan by screening the iShares ETF. A little bit about their company profile. They were founded in 2010. Their initial public offering was in 2018. Their founder is Wang Zheng. They're headquartered in Beijing, China, and the revenue segments consist of food delivery at 56% of the revenue, in-store hotel and travel at 23%, and new initiatives and other at 21%. So their current price is $110.50, which is actually up about $4 from yesterday's close. So there will be some adjustments that I will go over in my recommendation in this presentation because of the price change. Their market cap is $270 billion. Their 52-week range is $18.72 and then $112.15, which was what was experienced today. And in the last 2 weeks, their price has gone up over 12%. Meituan currently holds 60% of the market share of the food delivery industry in China, which was about $90 billion in 2019. Their leading competitors include Ellie Mae, which is Alibaba-backed, Foursquare, and Tencent. And Meituan experienced profits of $340 million in quarter 2 20, which is up 150% from quarter 2 19. If you were to download the app off the App Store, it would all be in Chinese. The image below shows US comparables to the features, Meituan lists. And then the other visual shows the timeline of the different consumer verticals Meituan has acquired. Beginning in 2010 as just a group discount platform, they now host over 10 features. The pandemic has accelerated restaurants' migration to online delivery services, and Meituan was able to directly experience this in their food delivery segment. Food delivery business increased 16.9% year over year to $16.7 million, and daily transactions increased 6.9% year over year to 24.5 million. Incorporated in my valuation is the future growth of the food delivery industry in China. The food delivery industry is expected to reach $56,936 million in 2021. Projected market volume of $67,622 million is expected by 2024. My second driver highlights a new trend in China, which is the grocery group buy. This segment will help Meituan consolidate their foothold on lower tier cities because the group buy initiative targets price-sensitive groups. The group buy segment was considered in my valuation as a way for Meituan to keep the growth momentum they experienced with their food delivery segment. The grocery group buy was launched in July 2020. Meituan expects a full year revenue growth of 32.2% year over year 21. The community group buying market reached $5.27 billion and is expected to triple to $15.82 billion in 2022. My third driver highlights improved US-China tensions. The Meituan ADR stock has been trading at an average 17% discount compared to the local share. As shown on the graph, the one day that the ADR stock was higher than the local share was on November 5th, which is days after the election when Biden was predicted to win. This supports the idea of improved Chinese market sentiment in the future with a new administration. Additionally, the Hang Seng Index surpassed the 30,000 mark in January 2021 and has climbed 7.6% since beginning of this year. A DCF model was constructed with a 6.05% WACC, which resulted in an intrinsic value of $139.52. This represents an upside of 32.51%. For 2019, revenue growth was 43.17%. For 2020 expected, revenue growth is 42%, and that is based on quarter 3 reports. For 2021 until 2025, revenue growth eventually declines and that is based on the expectation that the food delivery segment and the group buy grocery segment will eventually mature. For peer valuations, EV to sales, a multiple was calculated to be 10.57, which resulted in an intrinsic value of $99.40, which represents a downside of 5.60%. Additionally, a price to book multiple of 22.58 was calculated, which resulted in an intrinsic value of $78.47. This represents a downside of 25.48%. Peer evaluations were based on the idea that Meituan is still in the early stages of business development, and because of this, the peer that is most related to Meituan's current model is Pinduoduo, and that is why it was given a 40% weight. Additionally, like I mentioned before, there was a price adjustment, and with the price today at $110.50, the upside would be adjusted to 14.82%. Risks to consider include new regulations regarding antitrust, market competition risk, and variable interest entity. For antitrust regulation, there has been a recent crackdown against large technology companies in China, with the spotlight currently on Alibaba and its CEO Jack Ma. This could force Meituan to redevelop their location-based algorithms. Another risk is market competition risk, which is highlighted in Meituan's annual report. New companies seeking the lucrative returns of the food delivery industry may threaten Meituan's relationship with their consumers and merchants. And finally, Meituan is a variable interest entity, which is the only way U.S. investors can have economic interest in their business. Alibaba and Tencent also have VIE structures, and the risk is that the Chinese government could invalidate this type of structure. The CEO of Meituan, Wang Jing, was the third name listed on the 2018 edition of Fortune's 40 Under 40. With him, all 7 senior executives at Meituan are under 50 years old, with 2 of the 7 executives being female. Meituan may be the quietest $300 billion company in the world, but through COVID's acceleration of e-commerce, the implementation of the group buy segment, and relaxed tensions between the US and China, soon everyone will know Meituan's name. And it is for these reasons that I've recommended Meituan be added to the AIM International Equity Fund with a price target of $126.87.